Hey, all you realtors, interest rates are going to be much lower in 2025, right? Maybe not so much. Stay tuned and find out what's happening in the market and why interest rates might be higher in 2025. Hi, everybody. This is another episode of Going For It with James B. I'm James Becker, and I am the founder and CEO of Fusion Growth Partners. Recently, the Fed has dropped the prime overnight bank rate by 50 basis points, and the mortgage rates went up. I am an avid listener to the All In podcast, which is a group of venture capitalists out of the Bay Area. And there are a couple of people that we are going to listen to their opinion on why the interest rates might be doing the opposite of what we are all hoping to do. Chamath Papatia, who is famous for being one of the key drivers of Facebook, and David Sachs, who is a VC who invests primarily in SaaS companies and was a part of the PayPal mafia. Let's listen to the beginning of the podcast to set up what is going on in the markets currently. Let's watch.
And we're going to kick it off by talking about what's going on in markets, which is one of the kind of most interesting, challenging enigmas of the day. Or maybe it's not, maybe it's pretty simple. But there seems to be a diversion in assets that is pretty unusual, that hasn't been seen in some time. And a lot of market commentators, analysts, economists are kind of trying to figure out what's going on and why.
So this is the setup to saying there's some strange things happening in the marketplace that we're not used to. And this is why interest rates, mortgage rates seem to be going in the opposite direction of what we are hoping for.
The first is that bonds are falling. So U.S. Treasury yields, as a result of bonds declining in price, have spiked up. We nearly hit the 10-year yield dropping as low as 3.5.
Which is what we want. We want those yields to be lower because that translates into mortgage interest rates.
In September, obviously leading up to the big 50 bip rate cut. And as of this morning, we're seeing the 10-year yield over 4.25. At the same time, we're seeing gold prices spike. So gold is typically a safe asset, and gold has moved considerably, as you all can see here, from the start of the year, where it was around $2,000 an ounce, up to $2,750 an ounce, an incredible run up, one of the best performing assets of the year. And then finally, in a market like this, you would typically see pain in equities.
Pain in equities, meaning that the stock market would be coming down, that the stock market would not be so high as it is right now.
We've seen the opposite. The S&P 500 is up considerably, has been on this endless run-up, all-time highs, closing at all-time highs. Well, Chamath, give us your read on what's going on.
There's another couple of nuances here that I think are important. The US dollar complex is thriving, which means like the US dollar is strong. Back-end yields are rising. And then another thing that I look at is this thing called put-call skew. So basically, like on balance, how are people hedging in the short term?
Hedging the short term of what's going to happen in the future. Listen to what he says here that is interesting.
And in the bond market, they own a lot more puts than they do calls. I think that this is the entire financial infrastructure of the world repositioning itself from what was a toss-up election to a Trump win. And when you look at why, it's because when you forget the candidates themselves for a second, but if you think about the actual policies and where the spending will occur, I think that there has been a very clear decision that the Trump economic plan will drive better growth than the Harris plan.
If there's more growth, that means that there's more potential money in the system. There is more inflation potentially, which is good, but it has some negatives that come along with this. And if there is potential growth in the economy, more people are going to want to put their money into equities than to put it into a safe haven, which is bonds. And the more money that goes into bonds is what has a correlation with driving interest rates. Let's continue to listen.
And if you think that there is more growth coming, typically what will come with that is a little bit more inflation. The risk premium that you're going to need in a high growth environment is higher. What is risk premium? That is, how much do I want to invest for a risky asset versus a safe asset? And so all of these things are coalescing. So I think that the short-term takeaway that I have just looking at all of this data is that in the economic distribution of outcomes, this is now tilted overwhelmingly to a Trump win. And this is not an emotional statement or what I want to happen, but this is just an observation of how tens of trillions of dollars of self-interested financial actors have now repositioned their risk. And if Trump wins, which it looks like he's increasingly going to do, and if he wins by the margins that it looks like it's going to do, you're going to see a lot of these things exacerbate. Gold's going to go up more, probably. Bitcoin will probably go up. The short-term economic upside for the economy will probably get reflected in higher equity prices, but it'll also push out long-term rates. The inflation picture becomes a little bit murkier, but I think that that's what's happening. I think that the financial markets are pricing in a Trump win.
Okay, that was Chamath Palihapitiya giving his opinion on what's going on in the marketplace. And now we're going to hear from David Sachs, and we're going to hear what he thinks is going on in the marketplace and what is likely to happen in the future. Let's take a listen.
Well, I think, as you heard right there, the key line that Paul Tudor Jones said was all roads lead to inflation. I mean, that's what's basically happening right now, is that the market is afraid that inflation is not whipped and is going to resurface, and the Fed may have to pivot from the pivot and raise interest rates. That's why he doesn't want to own any treasuries. Separately, another financial legend, Stan Druckenmiller, gave an interview where he has something like a 20% short position, meaning 20% of his holdings are short U.S. treasuries right now.
20% is short U.S. treasuries. Treasuries is what drives interest rate. And Druckenmiller, who is like as big as they come as investors, has 20% that he is betting interest rates are going to go up. That's billions of dollars. And so that's a really interesting bet from somebody who is known to know what he's doing.
So he's betting that there are long-term inflation pressures and that rates are going to have to rise. And you're seeing, again, that since the Fed cut rates on September 18th by 50 basis points, that the 10-year T-bills yield has risen by 60 basis points.
So the 50 basis point cut from the Fed, we've seen the 10-year Treasury go up by 60 basis points. Pretty interesting.
My interpretation is that this is less about the election and more about the markets not liking the Fed's rate cut on September 18th. I think that in hindsight, it was too big. We discussed it on the show, and I pointed out that the 50 basis point cut was contradictory in the sense that the only two times in recent history where the Fed began a rate cutting cycle with a 50 basis point cut was in 2001 and 2008, which were on the verge of pretty big recessions. And so the Fed felt like it needed to cut dramatically in order to help stave off those recessions. But that was not Powell's rhetoric. What Powell said is the economy was doing very well. So what I said a month ago was, well, if the economy is doing really well, why wouldn't you just tiptoe into the rate cutting cycle with, say, a 25 basis point cut and then see how the market absorbs it and get another month's inflation data? Well, we've gotten another month of inflation data, and it's showing that these are not huge moves, but it's showing that inflation was a core CPI was just a little bit higher than expected. So again, the market is concerned that inflation is not whipped, that the Fed may have been overly precipitous in how it cut rates. And then the other thing is they just do not like the long-term fiscal picture of the U.S. One other chart we should bring up is interest on the national debt.
Okay, I don't know if you have all been paying attention to this, but since COVID and the Build Back America and all the legislation that has put money into the system, the interest payments on the U.S. debt has gone up, which means that we have to pay all of that. Let's listen to just a little bit of it.
What you can see here is that it has gone absolutely parabolic in the last couple of years. Our interest on the debt is something like 1.3, 1.4 trillion a year.
1.35 trillion run rate. Yep.
Yeah.
$3,500 per American.
Anyhow, they talk about this a lot and the need for arresting spending and for figuring out how to get this debt down for the health of the economy, for ourselves and for our children moving forward. Okay, I am going to put the link to this episode in here so that you can listen to it more, but I listen to this every week. They talk politics, they talk business. I find it fascinating. It is a source of news for me that I am able to digest and feel like I'm getting something that is somewhat balanced. There are two people here that are more conservative and two people that are somewhat liberal. They're all pretty much in the middle, though, and you might find it super fascinating. The bottom line is this, that they said, okay, with all of these changes, where are you going to put your money? And three of these guys are worth billions of dollars. The fourth is worth hundreds of millions of dollars. And the question was, what are you going to do based upon this information that's coming in? Do you trade? Do you move stuff around? And all of them just kind of came down to the basic same answer, which was nose down to the grindstone and just work. The economy is going to do its thing. Just work on your business and make your business the best business possible. And I want to emphatically encourage you to do the same. Don't worry about all this other stuff. Be knowledgeable, but keep your nose to the grindstone and work to make your business the best business that it can be. No matter what, people are still going to buy and sell homes no matter what the economy is. The worse the real estate market is, the less competition you will have because people will get out of the business. And the better you make your business, the more sustainability you will have into the future and the more wealth you will build. So regardless of what is happening in the economy, put your nose down and go to work. This has been another episode of Going For It with James B. I hope that you have found this interesting and valuable and worth your time. Thanks for listening, and we'll see you at the next episode.